global integration of capital markets has given many firms access to new and cheaper sources of funds beyond those available in their home markets. These firms can then accept more long-term projects and invest more in capital improvements and expansion. If a firm is located in a country with illiquid and/or segmented capital markets, it can achieve this lower global cost and greater availability of capital by a properly designed and implemented strategy. Gaining access to global markets should allow a firm to lower its cost of capital. This can be achieved by increasing the market liquidity of its shares and by escaping from segmentation of its home capital market. The cost and availability of capital is directly linked to the degree of market liquidity and segmentation. Firms having access to markets with high liquidity and a low level of segmentation should have a lower cost of capital and greater ability to raise new capital. In an example from the text, we see that a firm is able to increase its market liquidity by raising debt in the euro market, by selling security issues in individual national capital markets as euro equities, and tapping local capital markets through foreign subsidiaries. Increased market liquidity causes the marginal cost of capital line to flatten out to the right. This results in the firm being able to raise more capital at the same low marginal cost of capital and thereby justify investing in more capital projects. The key is to attract international portfolio investors. A national capital market is segmented if the required rate of return on securities in that market differed from the required rate of return on securities of comparable expected return and risk that are traded on other national securities markets. Capital market segmentation is a financial market imperfection caused by government constraints and investor perceptions. The most important imperfections are asymmetric information, transaction costs, foreign exchange risks, corporate governance differences, political risks, and regulatory barriers. Segmentation results in a higher cost of capital and less availability of capital. If a firm is resident in a segmented capital market, it can still escape from this market by sourcing its debt and equity abroad. The result should be a lower marginal cost of capital, improved liquidity for its shares, and a larger capital budget. The experience of Novo from the text was suggested as a possible model for firms resident in smaller emerging markets that are partially segmented and illiquid. Whether or not MNEs have a lower risk of capital than their domestic partners depends on their optimal financial structures, systematic risk, availability of capital, and the level of optimal capital budget.